Hello everyone, myself Namita Madik and my topic name is depreciation. So firstly, what is depreciation? In accounting terms, depreciation is defined as the deduction of recorded cost of a fixed asset in a systematic manner until the value of the asset becomes a zero or negligible. An example of fixed asset are building furniture, office equipment, machinery, etc. A land is the only exception which cannot be depreciated as the value of land appreciates with time. Depreciation allows a portion of the cost of fixed asset to the revenue generated by the fixed asset. This is mandatory under the matching principle as revenue are recorded with their associated expenses in the accounting period. When the asset is in use, this helps in getting complete picture of revenue generation transaction. There are three mainly inputs are required to calculate depreciation. First is useful life. This is the time period over which the organization considers the fixed asset to be productive. Beyond its useful life, the fixed asset is no longer cost effective to continue the operation of asset. Second, salvage value. Post the useful life of the fixed asset, the company may consider selling it at a reduced amount. This is known as the salvage value of the asset. Third, the cost of the asset. They include taxes, shipping, and preparation setup expenses. Why do we use depreciation? The purpose of depreciation is to achieve the matching principle of accounting. In other words, depreciation systematically moves the assets cost from the balance sheet to depreciation expenses on the income statement over the asset's useful life. How is depreciation used as an advantage? By charting the decrease in the value of an asset or assets, depreciation reduces the amount of taxes a company or business pays via tax deduction. A company's depreciation expenses reduces the amount of earning on which taxes are based, reducing the amount of assets owed. There are two methods commonly used to calculate depreciation. First is straight line method, second diminishing balance method. First, straight line method. According to the straight line method, the cost of the asset is written off equally during its useful life. Therefore, an equal amount of depreciation is charged every year throughout the useful life of an asset. After the useful life of the asset, its value becomes a nil or equal to its reducible value. Thus, this method is also called fixed installment method or fixed percentage on original cost method. Formula: amount of depreciation equals to cost of asset minus net residual value upon useful value. Advantages of straight line methods. The simplicity of this method makes it easy to understand and apply. Full depreciable cost of the asset in case of asset depreciation up to zero value or net scrap value can be facilitated. Same amount of depreciation charged in profit and loss account every year makes it easy to compare the profit for different year. This method is useful for the assets whose usage is consistent every year and whose useful span can be accurately guessed. This method can be easily applied to long-term asset. Disadvantages of straight line methods. When the comparison for 2 years is done for the usage of asset, this method does not reflect accurately the difference of usage in the asset. Matching of cost and revenue is not necessary when this method is reduced for a long-term asset. Rapidly developing technology software accounting field usage of straight line depreciation method for certain depreciation value. Example of straight line method. Suppose a manufacturing company purchase a machinery for rupees 1 lakh and the useful life of the machinery are 10 years and the residual value of the machinery is rupees 20,000. So solution: depreciation per year equals to cost of asset minus net residual value upon useful value. Cost of assets 1 lakh, net residual value minus 20,000 upon useful value 10. So equals to 8,000. Company can take rupees 8,000 as a depreciation expenses every year over the next 10 years. Second is diminishing balance method. Under this method, the amount of depreciation is calculated as a fixed percentage of the reducing or diminishing value of the asset standing in the books at the beginning of the year so as to bring down the book value of the asset to its residual value. The amount of depreciation goes on decreasing every year. That is, the amount of depreciation charged in each period is not fixed but it's gradually decreasing sum. This method is similar to the fixed installment method, with the exception that depreciation is charged every year at a fixed percentage and not on the original cost of the asset but on the reduced opening balance of the asset as brought forward from the previous year. Therefore, the system is called reducing diminishing balance method. Formula of diminishing balance method equals to cost of an asset into rate of depreciation upon 100. Example, company purchase a machinery costing 1,12,000 with a useful life of 3 years. The rate of depreciation is 20%. Solution, first year 12,000 into 20 upon 100 equals to 2,400. Depreciation value is 2,400. 12,000 minus 2,400 equals to 9,600. Second year, 9,600 into 20 upon 100 equals to 1920. 9,600 minus 1920 minus 7680. Third year, 7680 into 20 upon 100 equals to 1536. 7680 minus 1536 equal to 6144. Thank you.